Company valuation, an essential concept. Company valuation, such an important concept, isn't it? Perhaps we aim to understand a company's current market value or its future potential, but the real issue is how this value is determined. Let's take a deeper dive into this topic. Company valuation is a complex process that analyzes a company's financial status and future growth expectations, enabling investors, managers, and buyers to make informed decisions. But how does it work? 1. Income approach, discounted cash flow, DCF. The income approach is perhaps one of the most common and effective valuation methods. So, how exactly does it work? We estimate the company's future cash flows and then discount these cash flows to their present value using an appropriate discount rate. Steps. First, estimate the company's future cash flows. Then, discount these estimates to their present value using a discount rate. Finally, sum up all these discounted cash flows to calculate the company's total value. This method requires solid forecasts about the company's future performance. It's a task that demands careful attention. Second, market comparison approach. This method is relatively simpler, but still a robust approach. It involves comparing the company to similar companies within the same industry. That means analyzing the market value, revenues, earnings, and other financial data of those companies. 3. Asset-based valuation. What about looking at the company's physical assets? This is where the asset-based valuation method comes into play. Here, the company's value is calculated based on the total value of its assets. This method is particularly suitable for companies with substantial assets and liabilities. Steps. Calculate the net value of the company's assets and liabilities. Determine the company's net value based on this calculation. The key here is accurately calculating the value of the company's physical assets. 4. Earnings approach. Let's move on to a profit-oriented method. The earnings approach aims to estimate a company's value based on its future profits. Typically, profit forecasts are made based on past performance, and the company's value is calculated using an appropriate multiplier. 5. Equity valuation. Lastly, we have equity valuation. This method evaluates a company's value based on its equity. By subtracting liabilities and obligations from the company's total assets, the remaining equity value is calculated. This method is often used by investors and shareholders because the company's equity directly impacts share value. Factors to consider in company valuation sector and market conditions. The state of the industry the company operates in is one of the most critical factors in valuation. The future of a sector directly impacts a company's valuation. For instance, while the technology sector is rapidly growing, traditional industrial sectors may follow a more stable path. Growth potential. A company's growth expectations significantly influence the valuation process. If a company has strong growth potential, investors may assign a higher valuation considering this growth. Financial status. The company's current financial condition is also crucial. Factors such as revenues, expenses, debts, and profit margins reflect the company's financial health and impact valuation. Macroeconomic conditions. Factors like exchange rates, interest rates, and inflation can play a major role in company valuation. Economic fluctuations, especially for companies operating on a global scale, can have significant effects. Strategic goals and competitive advantage. A company's strategic goals and competitiveness in the industry should also be considered. A strong brand, effective strategy, and competitive advantages in the market can enhance long-term valuation. Governance structure. The company's management structure, transparency, and leadership quality are important factors. An effective management structure can increase the company's value. Company valuation isn't just about numbers. It's a process that requires careful analysis and consideration. It involves not only a company's financial status, but also its strategies, position in the market, and long-term objectives. By understanding company valuation, investors, managers, and other stakeholders can make more informed decisions and better assess the company's potential.